With the vast amount of stocks that are available, it can be hard to identify which stocks are a good value and which stocks aren't. Hey, you definitely want to pick me. I mean, I'm Apple. Nothing ever goes wrong with me. Oh, valuation you ask? Oh.
All around me are familiar faces, worn out places, worn out faces.
Does that really matter? Like, really?
What? What the fuck?
Of course it does. Wait, who are you? My name's Microsoft.
Thanks for just
Unlike
barging in.
you, I am undervalued.
What do you mean?
And have strong fundamentals. So hold that, ya pussy-all. Come on then, square to goal like! Tech ego, when will it end? Anyway, in today's video we'll be taking a look at 4 different stocks that are undervalued that you might want to have a close look at in the future. So let's get right to it.
I fight to live, I fight to strive. One day I'll have what I want in life.
Make sure to go over to the EXO channel, hit that subscribe button and hit that notification bell to stay up to date with all the future videos. Before we continue, I must say I'm not a financial advisor. This is not financial advice. Always do your own research. I'm not responsible for any decision making you do. Now that out of the way, we'll get back to the video. While the stock market sets a price for a company, this price may not always be correct. You'll have many factors that the company can't control. Nowadays you have hype, which plays a big part into the price equation. This is why it's important to look at companies and see if they're undervalued or overvalued based on the company's fundamentals. By comparing the market price and calculating a fair value price, by comparing the two together you'll be able to see if a company is overvalued or undervalued depending. And with this, investors can then use this knowledge to make wiser investment decisions and potentially get more gains by investing at better prices.
The glorious House of Gains, a place where life and death are meaningless and pain is gone!
Now there are many methods and equations that can be used to determine fair value of a company. Some methods work for some companies, some methods don't work on other companies. So today we'll be using a tool called Simply Wall Street. This tool / website is absolutely amazing as it calculates the fair value of a company automatically and keeps it up to date. And it will adjust the equation it uses depending on the type of company it is, so it always fits within the company. The only time this doesn't work so well is when there's not enough data to go by. If you want to learn more about this topic, there'll be links in the description relating to Simply Wall Street and the topic where it discusses how it calculates. Discounted cash flow, or DCF as it's shortened to, is regarded as the best method when it comes to determining fair value of most companies. Like I said, sometimes it doesn't work, but most of the time it's good. Especially with the Simply Wall Street version, as they use a 2-step discounted cash flow, not just a single. Okay, so the first company we're going to look at is Polymetal International. Now this is a mining company, and we'll head over to Wall Street, Simply Wall Street now, and check out the evaluation. Okay, so now we're on Polymetal International on Simply Wall Street. We can see we've head over to the valuation section. This website is broken down into sections. You've got valuation, future growth, past performance, financial health, dividend, management, ownership, and other information, and company overview. But we're just doing a valuation today. Like I said, if you want me to do an in-depth topic on this company, analyse it fully, I can do that. Just leave it in the description below, the comments below even. Jesus. So, valuation. You got this graph here, shows it real easy. There's nothing really to interpret out of this. It shows you current price and it shows you the fair value price. And there you go, 75.1% undervalued. You can see up here the ticks and X's. These represent some of the checks of how Simply Wall Street does it. So we'll look at them now down here. We have price to earnings ratio. Now we have the P versus industry and the P versus market being good. And then there's a graph here to illustrate that data. The company is at 8.2x and then the industry is at 8.5x. So pretty close them two. Now the market is at 23.2x. For me, I don't compare against the market too much unless the market is moving as a whole, so all sectors are sort of moving up or down, because they could indicate a bull run or a crash. So that's my opinion on that one. The price to earnings growth ratio. This company has a lot of potential to grow. With its mines, there's still a lot they can dig up. So we can see that its PEG ratio is good. Now the other one down here is price to book ratio. Now price to book ratio, you also have to consider the financial health when looking at this. So we can see that it is higher than the industry. That's probably because they took out a lot of debt that I can show you about. But I'll show you why this isn't too much of a problem. The financial health. Short-term assets outweigh the short-term liabilities. Obviously, you'd want this outweighing the long-term liabilities as well, preferably. The long-term liabilities do outweigh the long-term assets, outweigh the long-term liabilities, so that's still good. Now you can look at debt to equity down here as well. You've got cash flow and equivalents, you've got the equity, and you've got the debt. So the debt is pretty high for this company, but the equity is catching up with it. I predict it should go past that. And the debt to equity ratio has been reduced over the past 5 years. The debt is well covered by operating cash flow, and the interest payments are well covered by the EBIT. So that just shows you that this company does have some good financial health to it. It just has a lot of debt there, 2.1 billion, whereas equity is 2 billion. The assets are 3.1 billion. It's just with mining, there's a lot of obviously overheads you have to pay for, so this company will never be a great producer of cash flow. And that's it for the valuation of this company. Okay, so now we're going to look at Facebook. So we have a company overview here. It just lands you on the company overview first, and it'll show you like some reward. These things here, risk analysis, like a quick check, and these snowflakes represent the company of it. So there's no risk detectors for Facebook. So I mean, Facebook is a pretty safe stock to go with. Anyway, into valuation, we can see this is not as undervalued as Polymetal International, but it still is by quite a bit. So this would be a good time to pick up Facebook, assuming that this price is correct. You can do your own calculations to verify this, which I'd recommend doing. Don't just take everything here as face value. You need to do some additional research. But we can see it is undervalued by Simply Wall Street's calculations. Again, price to earnings ratio, we can see the price to earnings versus industry is good. We can see the companies up here. See, this industry is a bit higher in the PE. That's why I said about price to market. So you take things like this, the industry is quite high up, whereas the thing like Polymetal International and the mining, they were quite low. So that's where you've got to be careful when you're comparing it to market. But we can still see that one's better than the others, and it's not really a problem for a thing like Facebook. Price to earnings growth ratio is poor. Now this one, it depends. Facebook is a large company, it has struggled growing. There is this talk about augmented reality though, which Facebook is at the forefront of. If they can get this technology going and it's adopted, then that could be a big step for Facebook. Price to book, like I said, again you have to take in financial health into this equation. So the company is a 7.7, industry is a 3.8. So the company is higher, but when you look at financial health for a thing like Facebook, just look at that, like you're not really worried with the financial health of this company. The short-term assets outweigh liabilities in both the short-term and long-term, so that's just easy. And there you go. Its debt is nothing. It's zero, and then it adds 500 million there, but its cash and equity is more than enough. This company is like the dream team of financial health, debt free. So that's how quick and easy it is to value these companies from just a surface level. When you like a company more, you can go into it, you look at all these different sections. If it pays a dividend, if you like dividend, you can look at management, future growth, past performance, anything you want. So it's a very good tool to use. Now we'll head over to the next company and we'll analyze that. Okay, so now we're on another powerhouse of a company, being Alphabet, which is also known as Google stock. So we can see the valuation here. Its current price is under the fair value calculated price. A thing like Google is hard to value, like really. The Google is like unlimited in its potential, like it's the internet. It's really hard. I don't know how they value something like this, to be honest. It would be quite difficult for me personally anyway. Anyway, we have the ticks up here and some X's, so we'll discuss what they are down now. So price to earning ratio, the P versus industry, so we've got company there and industry there. So like I said, this has a higher P, well this industry has a higher PE than others, so that's what I said. Comparing the market is a bit dodgy. Price to earnings growth, now like I said with Google, with the large cap company it is, it'll struggle to find avenues to grow in. So this is to be expected really. Price to book, I don't think this is going to be a problem for everything like Google, but we can see that companies, their industry is lower, market, not too worried about. So we'll go to financial health and look at that. You're still absolutely fine. You're not going to be worrying about financial health with a thing like Google. It's too big, the cash flow is too much. You're good. Debt to equity, same story. Just look at that. It holds a hell of a lot of cash there. So we're good. Its debt has increased over the past 5 years though. So who knows? Maybe that has probably been to do with COVID that. So yeah. That's my assumption on that anyway. Balance sheet again, you got equity. There's 12.8 billion. You're fine. So it's so quick and easy to analyze these stocks like this. So now we'll head over to the next stock, and then we'll probably wrap up the video. And last but not least, we have Microsoft, which we had our friend earlier have an argument with Apple about. So that was lovely. So we can go to valuation, which is the section we want. And we can see that the current price is 300 and fair value is 381. So again, undervalued, but not by much. Well, considering the rest of the companies we looked at. Price to earnings ratio, again, we can see company there and industry is there. The company is still better than the industry, and the market, like I said, again, does not matter too much. Financial, oh no, we have price to earnings growth. Now this one is quite high up. Yeah, that's really high to be honest, but again, Microsoft's a big company. They say it doesn't grow that much, but it always releases new things, so I don't see Microsoft going anywhere anytime soon, so should be alright for that. And then price to book versus industry, again, we can see companies up here, whereas industry's down there. But go to financial health, and you're okay. A bit more liabilities on Microsoft part than other companies we've looked at, and we can see that it's cash. It's a bit of a cash flow machine. It's got more cash than its equity. Oh well, there you go. A different graph you don't see too often. And then we see down here interest well covered, operating cash flow covers its debt well. Yeah, you're fine. You're fine. The amount of cash this produces, and then down here you got 58.1 billion of debt, and then you got all these other things. So like I said, you're fine for this. Like I said, always look further into these companies, don't just take my word for them or simply Wall Street's evaluation for them. You can go down here to view data and it will show you what it's doing to calculate its evaluation model. Average of 33 analyst estimates, discounted rate, cost of equity 6.6, actual growth rate 2%, risk-free rate 2%, equity risk premium 4.7. It's very like in-depth, sort of bit more complicated thing to wrap your head around a bit. There is that other link that I'll put in the description that explains it a bit better. And then this is how it just calculates and does its thing really. Like when it doesn't have analysts, it uses estimates, so obviously the further you go out in the future, the worse the calculation is going to be. It's not going to be as accurate, so like these calculations will probably be more accurate, but as you go out it probably won't be. And then it keeps going and the calculation ends up to something like this. So yeah, that's just that. And now wrap up the video. Make sure you research all these companies further if you are wishing to invest into them. As I've said, this video has just been about valuation. That doesn't determine whether a company's good or bad, just means its value. So look at this yourself in depth and then you can make your decision. Just be aware that with all investments, your capital is at risk. It might go up, it might go down. It's just the way of the stock market. Bear that in mind. Okay, so I hope you got some value out of this content. Make sure to like, comment, subscribe, all that good stuff. Check out all the links in the description. You have the Trading 212 link for stocks. That's the one I use. You'll get a free share if you use that link. I also get a free share for that link. There's the crypto links down there. You got Blockfi and Gemini. I've had 2 videos recently up, one about Ethereum, one about Bitcoin, where I talk a bit about Blockfi and Gemini on there. Also, you have the Gemini, not the Gemini links, the Simply Wall Street links down there, the ones I mentioned previously, to go check them out. And I'll catch you in a bit. Peace out.
Tell me pretty lies, look me in the face, tell me that you love me.